InFi, episode 47.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I am going solo. We're going to do another episode on the intricacies and the mechanics of whole life insurance. That's a theme I'm going to be hitting more as we go forward, at least for a bit on the InFi podcast. But before I get into the topic of today, which has to do with why permanent life insurance is so special, or so, I think unique is the right word, at least in the class of life insurance, because of what's called the cash surrender value. That's what we're going to be exploring. Let me first discuss the policy ledger, which I don't think I've talked about here on the podcast. So we at Infineo recently launched our policy ledger, and in the coming months, I will go into more and more of its functionality and so on. But right now, let me just make the basic case for it, for why you should use it, is that we are solving the problem of what happens. Let's say you got a life insurance policy, you've been faithfully making the payments for decades, you want it to be there for your kids, you're doing your responsible thing. The inevitable happens, you pass away, and now your kids are planning your funeral, they're doing it. You don't want them having to say, oh, geez, did dad or mom, they had life insurance, right? And where do you think that is? What company was that? Geez, I don't know. And going through all your drawers and file cabinets and looking for this thing. You don't want them dealing with that when they're worrying about more important things. And so with the Infineo policy ledger, you as the individual consumer who has a life insurance policy, it can be term, it can be whole life, it can be anything. You interact with our system, you register your policy with our system, and then you can, again, this is all at your discretion, of course, but you can program into the dashboard people to contact on your behalf when the time is right. And so the system, through emailing you and other methods of verification, can ascertain whether somebody who's an insured that's for one of the policies in our ecosystem, if the system comes to believe that that person is no longer with us, then again, assuming that the person who originally registered sets these as his preferences, it can then send the relevant information to the people who need to know. So, telling them, here's the policy for which, you're an interested party. You contact, here's the carrier name, here's the policy number, and so forth. And this is all the information you need, right? So you don't have to go hunting for the policy statement that Uncle Fred might have tucked away in his drawer somewhere. Okay, so that's, again, there's a lot more functionality of why you want to interface with our system and tie your policy to the Infineo policy ledger, but I'll just tell you that for right now. And so as of this recording, we have $48.7 million of life insurance on our policy ledger, okay, from various people who have uploaded their policies and interfaced with it. And I will periodically check in with you folks and show you that number is growing very rapidly. So you want to be part of this. So go just to our main website, infineo.ai, and there's a button in the top right saying digitize your policy. And that's how you go to get started. It's very intuitive, and I won't push it more right now since this is the first time I've broached the topic with you folks, but I will periodically revisit this. Again, you want to go to infineo.ai and see how you can digitize your policy, basically creating an electronic backup copy of it so that when the time arises, people aren't fumbling around looking for this paper policy. Okay, so as far as the main topic for today, again, it has to do with why whole life insurance. I mean, it's permanent life insurance. I'm more of an expert on whole life, so that's why I'm going to be talking about whole life probably in this episode, why it's so special. And what prompted this is recently I was interacting with somebody who had a lot of expertise in modeling in the P&C, property and casualty insurance business, and talking with the person, I realized that in that line of work, there is no analog of the cash surrender value, right? So somebody who's even an actuary in other types of insurance, they don't right off the bat and understand how it is that the cash surrender value works inside of a permanent life insurance policy. And, when I realized that, I was like, oh, that actually makes sense, because there is no analog of the cash surrender value in other types of life insurance. It's only other types of insurance, I should say. Okay. It's only with life insurance, and specifically permanent life insurance, where you have this thing called the cash surrender value. And so I just want to walk you through that and explain it, just because at the end of this conversation, well, it's not conversation, the end of this monologue, since I'm talking to you guys, I hope you'll understand this asset better. And this underscores too why here at Infineo we're so enamored with these whole life insurance policies. And what we're doing, among other things we got going on, is tokenizing these whole life insurance policies to allow other people to access their interesting properties by lowering the frictions. Okay. Maybe, well, let me put it this way. First of all, what is the cash surrender value? You have a whole life insurance policy. Let's say there's $1 million death benefit right out of the gate, and you're paying your annual premium payments. And all along the way, there's built in contractually, it's guaranteed, a cash surrender value, and that marches up over time. So the original contract you get will show you, assuming you keep making your premium payments, at the end of year one, this is what you could turn the policy back into the carrier for and get a certain amount of cash. It's going to be a low number. It might even be zero, depending on the carrier at the end of year one. And then just keep doing that, and that it'll go up over time. It's built in contractually. And it's such that the cash surrender value rises and eventually meets or equals the death benefit at age 121. So if you happen to live to be 121 years old in the United States on newly issued policies, then it's $1 million death benefit. They just give you the $1 million. It's not really a death benefit at that point because you're still alive. Okay. And that's how these things work. So at any given time, the cash surrender value, as the name suggests, is just showing if you cash this thing in, stop making your premium payments, turn the thing over, you get a lump sum payment to walk away. So it's typically less than the death benefit. I say typically, it's always less than the death benefit, except in the case, again, where the policy matures, in which case they're equal. Okay, so that's what it is, and very simply. And let me contrast it with something else, just to kind of underscore how special this property or feature is. So you might think, okay, so over time you keep making your premium payments, and the cash surrender value of this policy just keeps marching up over time. And so that's kind of like if you buy a house with a mortgage, and every time you make a mortgage payment, the equity in your house goes up, and you just kind of see your equity rising steadily over time. So it's kind of like that, right? And for some purposes, making the analogy between buying a house with a mortgage and a whole life policy makes sense, and I've done that. That's one way of motivating the difference between a term life insurance policy and a permanent life insurance policy. Is they say, it's like the difference between renting an apartment versus buying a house with a mortgage. That you're not building equity when you rent the apartment. That's kind of like the analog of term life insurance, where you're just making flat payments to give you death benefit coverage for a certain term, a flow of protection. But then once that term's over, you walk away. You guys, have nothing to do with each other. You and the insurance company have nothing more to do with each other. Just like you pay your rent every month to get the flow of shelter services from your apartment building. But then when the term's done, the lease expires and you move out, you and the landlord have nothing to do with each other from that point. The landlord still fully owns the building. In contrast, when you buy a house and you keep making your monthly mortgage payments, the lien against the title to your house or the deed keeps shrinking. And so that's why your net equity tends to grow. So that's true. And that's kind of like a whole life policy. But where the analogy breaks down is that if you buy a house and you predictably make your mortgage payments, what you know for sure contractually is that the outstanding principal on the mortgage is going to go down at a predictable rate, right? In the early years, if you got like a 30-year mortgage, it's mostly you're paying interest and the principal, if you're making a $2,000 monthly house payment in the beginning, almost all of that is just going towards interest and the principal is only going down a little sliver. But when you're 15 years into the 30-year mortgage, much more of your monthly payment is being used to knock down the principal. So that's true. That's all contractually guaranteed. It's built in the front end. Strictly speaking, you don't know that the net equity in your house is always going to march up over time, right? Because really what's going on is your house is worth whatever the market price is, whatever the market will bear if you wanted to sell it. And then whatever the outstanding principal on your mortgage is, that's like the lien against it. So normally, yes, over time, the equity in your house goes up because we assume in general, especially over the long run, the market price of your house goes up. And so if the market price is going up while the mortgage lien is going down, then your net equity keeps going up too. But that doesn't need to be the case, right? And obviously a lot of people, maybe even some of you listening to this very episode, remember back when the housing market crashed, 2007, 2008, that there were a lot of people who all of a sudden were underwater, even if they had been above water the year before. Okay, so it's not guaranteed. Whereas with a whole life insurance policy, it is guaranteed, right? As long as you keep making your premium payments, your net equity in the policy is going to keep going up over time. All right, give another burst of realism here and specifics. You don't know in practice what the cash surrender value is going to be 10 years from now. You have minimum guarantees. You don't actually know how much it's going to be, though, because there could be dividend payments along the way which aren't guaranteed. But the idea is, in a typical year, the carrier is profitable. And then if you own a policy issued by a mutual company, you as a policyholder are yourself like a shareholder, an owner of the company. That's what it means to be a mutual company, that the policyholders are the owners of the company. And so you get a share of that dividend. Okay, but again, they can't predict ahead of time and they won't contractually guarantee how much the dividend is going to be. They lay out the framework that you as a partial owner of the company, this is how we're going to, the way we're going to allocate the total divisible surplus to the policyholders. So once you receive a dividend, if you use it to then buy more paid up insurance, which is typically the way you're going to design your policy in this context, then your cash surrender value jumps up because of that extra insurance you bought. And now that's a new plateau. So the cash value never goes down ahead of time. You can't predict exactly how much it's going to go up, but it always is going to go up. It's just that sometimes it might go up more than the bare minimum guarantee because of a dividend payment. Okay, so again, that's in some ways it's like buying a house with a mortgage, but in other ways it's better in that dimension. Okay, so just to think through this more, what is the actual definition of the cash surrender value? If you go to a life insurance textbook and look it up, it'll say something like the cash surrender value is the actuarially expected present discounted value of the future death benefit minus any remaining premium payments. Okay, so suppose the policy's paid up, right? Suppose you're at a point in the contractual arrangement of the policy where you don't owe any more premium payments, right? You could have something like there's things like a 10-pay, right? So you could have a whole life policy that's called a 10-pay structure. As the name suggests, that means you make just 10 annual payments from when you first open the thing. And once you make that 10th payment, boom, it's paid up. And now the thing just rolls. You don't owe any more money. You still have the death benefit protection, and the cash value still marches up in that policy over time. Also, you could have things like a paid up at 65, right? So the policy is structured such that when your age hits 65, that's the last premium payment. So it's not based on the number of years that you pay, it's based on your age. Okay. So they could do them that way. So let's assume you're in a type of policy but you could also have policies where Nope, you just owe the flat premium payment, the level premium payment until you die. That's just forever. Every year you owe whatever, $8,000 premium. If you want to keep this policy in force, that's what you got to pay contractually. And they could be structured that way too. So I'm saying, suppose we have a policy where at some point it is internally paid up contractually, then what governs the cash surrender value in terms of the actuarial science, right? Like if we're just being theoretical for a moment, not worried about government regulations and stuff, but just like the pure accounting of it, is actuaries looking at this thing from a financial economics perspective. At that point, it's like the person owns a bond of an uncertain maturity, where the death benefit is the principal amount, the face amount of the bond, but you're not sure when you're going to get it paid to you. All right. So if you knew exactly when it was going to get paid, right? Like it's very straightforward to say, oh, I've got this bond that's a zero coupon bond, right? So you're not earning payments along the way. And it's just saying the owner of this bond is going to receive $10,000 12 years from now, right? So if you want to say, how do we evaluate what's the market price or the value of that bond right now, knowing that it entitles you to get paid, whatever I said, $10,000 12 years from now? Well, you just figure out what's the present discounted value, and you use whatever the market interest rates are to discount that future cash disbursement to present value terms, and you come up with your number. If it's a bond issued by a riskier company where you're not sure are they really going to pay, well, then you take that into account, and so the present value is lower than it otherwise would be because you got to have the risk premium built in and that kind of thing. All right, but that's how that works. So that's pretty straightforward. But now what if you say, okay, we're not sure exactly, the owner of this bond is going to get $10,000 cash payment when the event happens. We're not exactly sure. We're not sure that's going to be exactly 12 years from now. It might be, but it might also be 8 years from now. And it could also be 9 and 10, and we'll give a probability distribution. Maybe there's a 20% chance it's going to be in any of those 5 years. 8 years from now, 9 years from now, 10 years, 11, 12. Maybe there's a 20%. Now, how do you evaluate that? So the fact that it's still, those are all future events matters. The interest rate, the discount rate, because they're future dollars, so they're not worth as much to you right now. But now you also got to take into account the fact that you're not sure when they're hitting. And so you got to take into account there's a 20% chance that I'm going to get the money in 8 years. And so that would be discounted less heavily. But there's also a 20% chance I'm not going to get it, what I say, for 12 years. So you're going to discount that a lot more, right? And so that's how you would do it. And so you can come up with a way to evaluate that has to do with a given scenario and then what's its probability of occurring, and you kind of lump them together and you can make different assumptions about, are you risk averse and that sort of thing. Okay. So that makes sense. And that principle that I just explained to you, that's how you would come up with the cash surrender value, just using the actuarial formula for a paid up life insurance policy, because they're, to the owner's, the policyholder's point of view, this thing is just a pure asset to them. They just hang on to it, and it's going to give them a payout at some uncertain, distant future date. And then you could evaluate it accordingly. And so there, it's the actuarially expected present discounted value of that future death benefit. So the actuarial, so there, what I said a minute ago, imagine it's like a 20% for each of those 5 years. Well, that's not really how the life insurance works, right? Because the event that triggers the payout is the death of the insured. And so with human beings, the older they get, the higher the probability of death in the next year, should they survive that long. So it's not just like there's a constant 20% chance that you're going to die. That no, each year you survive, in general, certainly if you're looking at statistical aggregates, the chance of you living one more year gets lower and lower over time. And so that affects things as well in terms of assigning those probabilities of when the payout occurs. Okay? But that's kind of the idea of how you would do it. Now, one other curveball, suppose it's a bond that pays $10,000 to the owner, but there's a probability distribution about when that happens, that payout occurs. And on top of that, in order to keep that alive, to keep that payment contractually due, the owner of that bond needs to periodically, like every month, send in $500 to the company that issued the bond. And so now, the further in the future that payout occurs, that means the longer stream of those payments. Okay. And so you can see how, other things equal now, the present value of that asset to you as the owner is lower, right? If now it's like, oh, it's not just that it's pure gravy and I'm getting, I don't know exactly when, but at some point in the future, I'm getting $10,000. But now you tell me, oh, but for that to happen, every month you got to pay $500 or whatever I said. Now, that's not nearly as attractive because I got to have money going out the door to keep that option alive. And so that would greatly reduce the present discounted value to me of that future payment. Okay, so that, again, just to remind you, what I said is the wording, if you try to get a more formal definition of what is the cash surrender value, it's something like the actuarially expected present discounted value of the future death benefit minus any remaining premium payments. And that's the way you would do it. So for different, so again, technically the way they could model that is look at every possible outcome from this point forward, all the different dates on which the person might die. And then for each of those scenarios, calculate how many premium payments does the person make, and then what's the death benefit payment they get, and blah, 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 and then discount them all to present and get a total present discounted value. Okay. So those are the principles of how that stuff works. And that's why, now that I've gone through all that, you can see, so as time passes, the cash surrender value in these policies grows because there's two different things going on. On the one hand, like let's say every time a year goes by, why would the cash surrender value in my whole life policy go up? Well, because now the death is 1 year closer. Right? We don't know when I'm going to die, but for every year that passes, it's 1 year, it's 1 year closer. And strictly speaking, in terms of how the contracts are written and everything, like it's actuarially. All right. So we're not doing this isn't like a Calvinist determinist framework that, no, from the dawn of eternity, it was written in the book of life or whatever, like when you were going to die. And then clearly whatever that is just gets closer. Even though that's true, given one's metaphysical views, that's not what I'm saying. I'm just saying, like, when they're modeling it and the actuaries are building the contracts and stuff and saying, what do we have to charge as a premium to keep these things going and make sure we cover ourselves, that the way they model it, that yes, given human mortality, every time somebody gets a year older, now death is closer. And so that death benefit is discounted less heavily because now it's not as distant in the future with the passage of time. So that's one reason the cash surrender value goes up. Because again, the cash surrender value is like the shadow of that future death benefit payment. It's the anticipation of it. So it's not as big because it's just the anticipation. It's better to have the $1 million right now in your hand than to know at some distant point in the future, you're going to get $1 million when this event occurs. No, it's better to have the money right now. So that's why the cash value is always lower than the death benefit. It does increase over time because, again, for one of the factors is that death gets closer and closer, so it gets discounted less. And then on top of that, another contributing factor, if the policy does have remaining premium payments, with the passage of time, there's fewer such payments left. And so the offset to the present value of that looming death benefit, but you're going to subtract out the remaining premium payments to get the net value, as it were. Well, as time passes and you're making more and more of those premium payments, there's fewer left. So there's fewer liens against that future death benefit, if that's the way you want to think about it. So that's another reason contributing to the fact that as time passes, the cash surrender value grows in these things. Okay. So now that we've gone through all that, let's just analyze, just to think through, why is it? Because it's certainly true empirically, if you just look around and say, in the realm of insurance products, you see all kinds of insurance. You got not just insurance on human lives, but also, on your automobile on your house, in case your house burns down, you have an insurance policy. You have all kinds of different policies on various things. And why is it, as far as I can tell, and I have asked around, and so far nobody's given me a clear-cut counterexample, where I said, as far as I can tell, having a cash surrender value feature in an insurance contract only exists in life insurance, and then more specifically permanent life insurance. Things like a whole life policy is a quintessential example, but a universal life policy can have it as well. All right. And so why is that? And I think, just as the last chunk of this episode here, I'll just walk you through. Let's just think about, why wouldn't it make sense to have a cash surrender feature for a policy that you have on your truck? All right. So let's say you got an expensive truck and you've got an insurance policy on it, and such that, if you get into an accident, and let's say the truck is $50,000, all right, to get it new. And so you got a auto policy that's up to $50,000. If it got totaled, then you would just get a check for $50,000, go buy a new truck. All right. And now, why is it that is just like a term policy? It is what it is. You pay the premiums to have that coverage in force. And it's not that with every premium payment you make, there's an amount that the carrier that has issued that auto policy on your truck is going to say, oh, if you ever at any point decide you don't want this insurance policy anymore on your vehicle, you can just surrender it back to us and we'll give you a spot payment. It won't be as high as $50,000, but it'll march up over time. Right. And maybe the first year it's $5,000, and then the second year it goes up to 15, and then like that. And then, 8 years into the policy, you know what? I'm going to sell my truck, give it to somebody else. I don't need this insurance policy anymore. So here, I'll turn this in and get $35,000 for it. That doesn't happen. No, when you sell your truck, you just call up the insurance company and say, I want out of my policy. I'm not the owner anymore of that vehicle. And they say, okay, thanks for your business. Thanks for all the premium you sent over the year. We owe you jack squat. See you later. That's what happens. So why is that? Whereas again, with life insurance, if you've got a permanent policy, so you got a whole life policy, and you had it in place because you were worried that, oh, gee, if I'm the breadwinner of the family, and if I were to die when we still have this big mortgage and the kids haven't gone to college yet, I wouldn't want to leave my wife, with this huge financial burden. Now she wouldn't have me working. So I got a life insurance policy. Let's say it's a whole life policy, and I'll do it. And then over the years, the kids went to college. We managed that okay. We paid off the house, and now I'm 70 years old, and you know what? I don't really need this much life insurance anymore. I don't want to keep making this premium payment. I think I'm done. Insurance carrier will give you a hefty spot payment to get out of that contract. So why is that? But by the way, I'm not recommending that. Right? Like these whole life policies are nifty little assets, and especially if you've been paying into it for a long time. But I'm just saying, hypothetically speaking, someone in that circumstance could do it, whereas that's not the case for other types of insurance products. So why is that? And that's what we're trying to understand here. So think to the truck. So and by the way, I have an article at the Infineo website on this stuff too. So I'll link to that if you want to, if you're driving in your car or something, you hear me give this episode, and you want to go read about it later and get more rigor, you can do that. But intuitively, just to finish this train of thought here, I think the fundamental difference is that the truck policy, there's no period at which to say, okay, clearly the truck will, quote, be dead at this point, right? Because that's kind of what's going on with the whole life insurance product, is that the way it's structured is that, and the reason it's called a whole life policy, is that it will be enforced for your whole life. And I alluded to this earlier. Strictly speaking, these things complete once you hit age 121. So technically, somebody could outlive it, unlike a term policy where, if you're 30 years old and you take out a 30-year term policy, once you turn 60, that's the last year of the policy. If you live beyond that, boom, the policy's done. You get nothing. In contrast with the whole life insurance policy, if you're 30 years old when you take that out, 91 years later, when you turn 121, you in a sense outlive the policy, but then they give you the death benefit. Okay, so that's the fundamental distinction contractually between these two types of policies. So that's why, again, it's called a whole life, or the broader category could be called permanent life insurance versus term, right? So that's really driving home the distinction. Okay, so one way of seeing it is other types of insurance products that are taken out on things that aren't human lives, like a boat or a car or a truck or a house, or, commercial real estate, your jewelry, if you're insuring against it being stolen or something. Those are not permanent insurance policies. Those are term policies. You say, okay, so you push the problem back one step. Why is it then that if I want to have insurance on my truck, how come I can't get a permanent insurance policy on my truck? Why is it just always term? So here I'm kind of circling back to what I said before here, but I'm giving you more context as to the significance of it. That I think part of the reason is with a human being, when the event that triggers the payout is the death of the insured human, that's a pretty cut and dry distinction. Whereas with a truck, it doesn't really work to say, oh, the owner of this, the person who took out this policy on this truck, you will get $50,000 when the truck dies, right? Because it's, if you get in an accident, it's totally wrecked, that works. But absent that, there's a lot of intermediate things where, maybe I don't want to drive anymore, but I'll sell to somebody else kind of thing, right? And you could put in a lot of money to give it a new engine and this, you could do all kinds of stuff to keep the truck alive. And so there's not this clear-cut distinction between the truck, is it still viable or is it dead? Whereas with human beings, particularly historically, right? So that's one interesting thing that I got into in my article was I said, this could change. And I'll come back to that in a minute, but let me just finish this train of thought. Okay, so that's part of the issue as to why it wouldn't make sense to have a permanent insurance policy on your vehicle. And then if you understand that, then that ultimately explains, okay, so that's why there's not a cash surrender value. Because again, with the whole life insurance policy, think of it this way, the carrier knows that at some point, as long as you kept up your end of the deal by making the premium payments, they're going to have to pay you. At some point, you're either going to die or you're going to live to be age 121. And so they got to pay the face death benefit. So when you're making those, and they know that, so they take that into account when they set the original premium structure. And so in a sense, early on, your premium is way higher than it needs to be just to cover the pure mortality risk of that year. And so that's why, as is well known in this area, is, guys like Dave Ramsey will not hesitate to point out, to get a given level of death benefit coverage, if you have a term policy, it's way cheaper. The premium's much lower than if you have a whole life policy with the same face death benefit. And as I say ad nauseum on this stuff, that's not because the insurance company's ripping you off or because whole life is a bad product type. It's just because of what you're getting, right? Like if you're 30 years old and you get a 30-year term policy, the premium's going to be such and such. If you get a whole life policy with the same death benefit, of course the premium's going to be higher because that's effectively a 91-year term policy, where if you happen to live to the last year, you get the payout. Whereas with the term policy, if you happen to live to the end of the term, you don't get anything. So of course, it's much more valuable to you as the consumer to have a whole life policy with, say, $500,000 in death benefit coverage than it would be for you to have a 30-year term policy with $500,000 in death benefit coverage. The former asset is far more valuable to you. And so that's why it makes sense that the premiums you have to pay to keep it in force are going to be higher. Okay, but now given that that's how it works under the hood, that the carrier, in a sense, in the early years is charging you much more than it needs just to cover the actuarial risk. But let me put it to you this way. Consider two different extremes. You got a bunch of 30-year-olds, and one group of the 30, like you got 10,000 of them, and 5,000 of them buy term policies, and 5,000 of them buy whole life policies. That's what we're imagining right now. So the 5,000 30-year-olds, let's say they just buy 1-year term policies. So here, what the carrier needs to do is figure out of this group of 5,000, and let's say they all have the same death benefit on these policies. So they're all in this like a homogeneous block, and they're all the same health rating. Okay. What the carrier needs to figure out is the actuaries, show them is, okay, this group of 5,000, since it's only a 1-year term policy, we just got to guess how many out of this 5,000 are going to die this year. And then what's that number times the death benefit we got to pay per person. So that's the aggregate amount we got to pay in death benefits to this group this year. So what do we have to charge everybody? Keep it simple. Assume it's just an upfront annual premium payment. What do we got to charge everybody so that number times 5,000 equals the number we think are going to die times 500,000, which is the death benefit we're assuming in this example. And then that's the way you could do it to a first approximation. Obviously, there's overhead and, they're not sure, they got to be conservative, but that's intuitively the way to think about it. In contrast, if they got a pool of 5,000 people who are all 30 years old, same health status as the other group, but now what they're buying is a whole life insurance policy with a 500,000 death benefit face amount. It's not just, how much do we need to charge so that the amount of money coming in the door is able to cover our death benefit payouts this year, the way it was on the 1-year term. No, because they know, most people aren't going to die this year of this 5,000. We're now on the hook. When we set the premium for this thing, if they keep doing that year after year, they keep the policy alive. So it's not just a one-shot consideration. It's now like a continuing game, a multi-round game. And so it's got to be such that the amount we charge from the group that's still alive is that the 5,000 shrinks year after year as people die off. And then as they get older and older, the percentage of the remaining pool that goes away goes up over time, right? The survival rate goes down annually, right? So now you see how that's a much more complicated problem, but also clearly the premium they end up charging in that second scenario is going to be a lot higher. But then think through, what does that mean? So what do they do? In when the people are all age 30 and the life insurance company takes in these pretty high premium payments, because in a sense, it's like they're overcharging in the early years to make up for the fact that when the person's 85, the premium they pay that year is going to be a lot less than the pure mortality risk. If you just consider that one factor, there's something called value at risk. That's complicating what I just said, but put that aside. So what do? Is they invest those premium payments, right? So the first scenario where it's just a 1-year term, they might take the premiums in and put them into T-bills or something. It's mostly just rearranging the money, right? You got money coming in the door, some people die, you pay them, and then whatever's left is the insurance company's profit. Whereas if you're doing a whole life policy, that is a much longer term game where most of the premium payments you're taking in the early decades aren't being used to fund outgoing death benefits, but instead are being invested into assets that sit on the insurance company's books. And those grow so that the carriers down the road can pay off everybody. Because again, they know that if the people stick with their end of the bargain, we have to pay them. Okay. So that's why the carrier now, getting those incoming premium payments, having this growing pool of assets, is willing and able to make the cash surrender payment that somebody comes up at some point in that process says, I want out. So now the carrier, has a portion of their assets on their balance sheet that in a sense are earmarked to back up that one person's policy. So now they can afford to sell off those assets and give the money to the person for them to walk away. So they're no longer in the pool of people who at some point are going to claim the death benefit. All right, so that's kind of the intuition of how that works. And what drives that is that the human life, they're pretty confident most people are going to be dead by age 121. So they can kind of take that as a finite length of this, do the actuarial calculations, just work backwards. And then they also know, again, just they put it in there for completeness to say, if the person happened to live to 121, we would just go ahead and give you the money just to complete the thing. But they think in practice, that's going to be a vanishingly small number of people that do that. All right. Again, whereas with the truck example, that doesn't really work. Also, like with a building, like if it's a fire insurance policy, if the building doesn't burn down this year, it's not like the chance of it burning down next year goes up. And that over time, like, oh yeah, that's the building will almost certainly burn down by this year. That's not how it works. Notice what I'm not saying that, hey, if we expand the horizon long enough, at some point we're pretty sure the building will have burned down in that interval. That's not what I'm saying. I'm saying something stronger. That with a human life, it's not merely that we say, oh yeah, by the time you're there's a newborn and we say, yeah, there's almost 0% chance that kid's going to live to be 150 years old. That's a true statement, but you can say much more than that about how human beings are, is that as you get older, your mortality risk also goes up. Okay? So let me just make sure you're getting the distinction I'm making. Suppose there's a 1% chance that this building's going to burn down in any given year. And over time, that risk is constant. Every year, there's a 1% chance the building's going to burn down. Now, I can say with confidence, probably over the next 200 years, that building's going to burn down. You could do the calculations, say the chance of this building not burning down over the next 200 years, given that every year there's a 1% chance, it's like, you'd have to get the 90, it'd be 0.99 raised to the 200 power, and you do it that way, 1 minus that or something. Okay? So that's how you do it, and it's going to be a low thing. But that's not merely what we're saying when it comes to a human life, is that no, over time, your mortality rate itself goes up such that every year you last means you're much more likely to die the next year. Whereas, again, with a building with burning down or something, that's not the case. So I'm just giving you all these reasons as why it is there's something kind of special about a human life and why there are such things as permanent life insurance policies. I think there's also other elements involved. There's emotional attachment, and that element comes into play as well. But again, just like economically speaking, I think that's one of the fundamental reasons that we see in practice, just empirically looking around, that you have this cash surrender value feature embedded in whole life insurance, but you don't see it in term policies and you don't see it in other types of insurance. And so last thing I'll say here is where those things might change in the future, just to say that's not necessarily set in stone, but I just think historically that's why you see these patterns, is on the one hand, as medical science progresses, the human body might come more and more to resemble the truck, where if you saw the interview I did with Matt DiPaolo a few episodes ago here at InFi, where he was talking about how they're at the point where they're able to 3D print human organs, and that's just going to get better over time. Right. So at some point, it'd be like, oh, you got lung cancer? Well, hang on. Maybe you got to take a sample of your DNA or something, and then we're going to grow you new lungs in the lab here, and then come in next week and we'll do a transplant and give you new lungs that are your exact genetic match, so that your body's not going to reject them. And, you could do like nanobot, give you a shot, and then these little robots that are the size of human cells spread through your body and repair stuff and do all kind of, or they attack bacteria or viruses or whatever. Okay, you could imagine that, or they rebuild your nervous system. Right, so in situations like that, it could be the kind of thing where if somebody just doesn't get completely obliterated in some kind of industrial accident, maybe they can make people virtually immortal. And just like with a truck, yeah, you could, if you wanted to, just keep replacing the individual components and keep the thing going indefinitely. So maybe human beings will get to that point, in which case the life insurance companies might have to alter their contracts, and maybe they only do term policies because it just doesn't make sense. No, what you're paying for is coverage for this term, because it's not like we can look ahead to say, oh, clearly there's going to be a finite endpoint, and then we can just work backwards with the actuarial calculations that no, we can't do that in that scenario. Going the other way, I could imagine, as AI progresses and robotics technology is also developing. So when they're at the point where they got GPT-10, GPT version 10, and they're putting it inside of a robotic body that has fine motor skills and can walk around and jump and, lift up heavy crates and things like that and be pretty graceful. And it's got built-in collision avoidance systems that it knows not to step on a kitten and things like that, right? That at some point, maybe that thing is so economically similar to human labor that the owners of those androids take out insurance policies that are like whole life policies on human beings. Who knows? Again, it would depend on, I guess it would have to be that the thing only has a finite lifespan, in which case, it breaks down or something for that to work. But my point is just, maybe. So I'm just kind of showing, like, technologically, as the human body comes to resemble more of a truck, then maybe the life insurance product type that doesn't work on trucks no longer would work on a human being. Or I could see the other way, that as certain types of capital equipment, because of technological development, come more and more to resemble a human worker, well, then maybe a life insurance policy, because you could have a COLI policy, company-owned life insurance, on your key employees, right? So maybe if there's just a finite span in which the android is useful to work at your company, and for whatever reason, after a while, he's like, no, we get rid of it at that point. Maybe it would make sense. I don't know. So I'm just kind of showing you those two different endpoints of the spectrum to underscore why it is right now in the real world, given technology, and how there are some pretty fundamental differences between human beings and other types of assets, if you want to just think of it that way, that we see certain insurance products that have special features that are only relevant or exist when the underlying insured asset is a human life. And this is of interest to us in general in Infineo too, because our founder and CEO, Cole Snell, often says that the most valuable asset in the world is a human life. And that what life insurance does is help to sort of monetize, to appraise that, to evaluate and quantify that value in a market setting. Okay, well, I will wrap it up there. Thanks for your attention, everybody. And again, if you have a life insurance policy, go ahead and digitize it, onboard it at our policy ledger, and you can do your part to add to the growing total, which currently is at 48.7 million, and get the peace of mind knowing that you put in all this hard work to make the premium payments to have that death benefit in force for your beneficiaries. So why don't you set up a backup system to make sure they get all the relevant details when the time is necessary. Okay, folks, see you next time.
This concludes another episode of InFi, the Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit infi, thefutureoffinance.io. Thanks for listening.